With weak data in Japan and a stronger dollar, we've seen dollar yen pushing higher. But what can we expect going forward? Hello and welcome back to our channel. My name is Daniela. And in today's video, we are going to be looking at dollar yen because we have seen the bullish trend continue, hitting that significant 150 mark, which has entailed so much in the past. So in today's video, we'll be looking at what the latest data has been showing, but also jump on the charts to see how the pair has been trading. But before we get into this video, please like, comment, subscribe, and turn on your notifications. And as always, if you have any questions about trading or the markets in general, feel free to leave them in the comment section and we'll try and get back to you as quickly as possible. So this week, we've seen the latest growth data in Japan showing that the Japanese economy has in fact fallen into a technical recession in the second half of 2023. The quarter-on-quarter growth for the third quarter actually showed a contraction of 0.7%, followed by a preliminary 0.1% contraction in the fourth quarter. Now, this data could be revised further, and it could actually deepen or worsen the economic projections for Japan. But for now, it looks like a technical recession could have actually happened in the second half of the year. Now, a lot of this actually coming on the back of weak domestic consumption, whereas actually exports made a positive contribution to growth. So a lot of this weakness coming from Japanese consumers, coming from domestic consumption and internal demand. Now, as we know, Japan imports a high level of energy. I think around 95% of the energy in Japan is imported, as well as around 60% of their food. So we've seen the Japanese yen weakening, and this weaker yen has actually been contributing to the higher cost of living for Japanese consumers, which in turn has been slowing consumption and demand. So it's kind of entered this vicious cycle, which is not unknown for the Japanese economy, because whilst most developed economies have had an issue of hyperinflation, specifically in the last 2 years, since recovering from the COVID pandemic, and also with the war in Russia and Ukraine pushing energy prices so high, we've seen this issue of hyperinflation and central banks struggling to keep inflation under control. We've kind of got the flip or the opposite in Japan. Now, the Japanese economy has a history of having deflationary pressures, has a history of struggling to get domestic consumption going and to kind of power the domestic economy. And even though in the last year and a half, we have seen consumer prices tick up, we've seen both core and headline inflationary data, CPI, actually coming in above 4% over the last few months in Japan. The Bank of Japan or Japanese officials have the impression that inflation is not being driven by domestic demand. It's being driven by external factors, most notably the increase in food and energy prices, which are imported. So the fact that the CPI has been showing around 4% hasn't enticed the Bank of Japan to increase rates. Now, we know the Bank of Japan is one of the most dovish out there. They've kept interest rates in negative for the last few years, even throughout the whole hiking cycle that we've seen over the last 18 months elsewhere. We've seen the Bank of Japan really remaining sturdy in their decision. Yes, they increased the yield curve control bands, but in terms of hiking rates and trying to stem inflation, we haven't seen that from them because, as I said, they believe that the issue isn't domestic, it's external. So a lot of this has kind of led to speculation as to when the Bank of Japan is going to exit negative policy rates. Now, as I said, there is a cost of living crisis, and a lot of that having to do with the high prices of imports. But of course, the weakening yen isn't helping. And the fact that we've got the rate divergence between most of these developed economies and Japan is driving the yen weaker. So dollar yen has been pushing higher because the Federal Reserve has kept a more restrictive policy compared to the Bank of Japan. Now, earlier last week, and we'll see the chart in just a second, we saw dollar yen push up significantly, and that was on the back of a stronger dollar because the latest CPI data in the US actually pushed back on expectations of the Federal Reserve cutting rates, which has kept the rate differential in favor of the US dollar over the Japanese yen. So all in all, a lot of economists are expecting that the situation in Japan in terms of consumption will not improve until we see policy action from the Bank of Japan. Now, the bank is supposedly waiting to have wage increases be applied in the economy. They expect that wage increases will create more consumption and therefore create more domestic inflation and therefore allow the central bank to act. But it is a very tricky situation. Markets are anticipating that the Bank of Japan may exit negative policy in their meeting in April. But of course, this latest GDP data potentially weighing on those expectations because it does question whether the economy is ready to exit that negative policy rate, given the fact that it's struggling, even though inflation has picked up and is now falling once again, as I said, mostly on the back of those external influences on inflation. So we saw those expectations for the policy change in April increase. They're currently standing around 45% chance that they will increase the bank rate to 0% from minus 0.1. But also what is expected from growth going forward. Goldman Sachs actually coming out and saying they expect growth in Q1. They expect the economy to grow around 1%, which is actually falling in line with other estimates that we're seeing. So even though we have seen a technical recession in the second half of the year, it doesn't seem to be weighing on forecasts. So that potentially could entice the central bank to act over the coming months. Also, are we going to see any FX intervention? As we know, Japanese officials have intervened in the past in the market when they believe that the weakening of the yen has gone too far. In the past, the 150 mark against the dollar has technically been used as a kind of threshold. It's never been officially confirmed, but markets do seem to believe that in the past, when dollar yen has reached 150, that is usually when we get FX intervention. There's been a lot of talk about it in recent days because we have seen the pair actually breach that level last week. Whether it's going to happen or not, officials haven't actually confirmed. They have said they are monitoring the market daily. So we could potentially see somewhat of an intervention. If that were the case, we would expect to see dollar yen retrace on the back of that. It wouldn't change the fundamentals. It wouldn't change the long-term direction, but we would see a little bit of correction in the market. We saw around, the last time we saw intervention, I believe, was at the end of 2022. So it's been a while since we've actually had that, mostly on the back of the falling dollar in the last half of last year. But we could potentially see that coming over the next few days if dollar yen continues to appreciate. So let's jump onto the chart now to see what we can expect from the pair. So as you can see, we've got the dollar yen chart here, Capital.com via TradingView. As you can see, on Tuesday last week, that appreciation on the back of that stronger CPI data in the US, pushing back expectations of a rate cut from the Federal Reserve. Now, as I was saying, the Bank of Japan wanting to exit negative policy, but struggling to do so. And I think even if they were to hike rates in April, they wouldn't be able to do it continuously because the underlying data is showing that the economy is weak. The economy would not sustain hawkish policy action from the Bank of Japan. So the long-term momentum for dollar yen is going to come mostly on the back of the dollar side. Now, as long as we have expectations that the US economy is resilient and that no rate cuts from the Federal Reserve expected, we would expect dollar yen to continue pushing higher. As I said, we may see FX intervention from Japanese officials that would cause a little bit of a retracement and a pullback. We saw that last time back here at the end of 2022. So we could potentially see a pullback on the back of that potential intervention. It hasn't been confirmed. It never is prior to the event. It's always just done and then communicated to markets. But we could potentially say that there is a retracement in line if we were to see that intervention. But even then, the fundamentals, as I say, are pointing towards a stronger dollar yen on the back of that rate divergence between the Bank of Japan and the Federal Reserve. Even if we were to see the Bank of Japan hike rates, as I said, it would definitely cause a reaction in markets, and we definitely would see dollar yen correcting lower. But again, the sustainability of that move would be questioned on the back of the weakness of the underlying Japanese economy. So for now, it looks like the path of least resistance continues to be higher in the longer term, although traders should be aware that we have reached that area where we tend to see resistance. I was saying that 150 mark is quite psychological. As you saw, we reached that last week on Tuesday on that stronger dollar, but quickly retraced lower and now just hovering around that 149.98. So really just below that 150 line. Again, testing the appetite to push higher and to test Japanese officials and whether they are ready to intervene once again. We could potentially push all the way to 151.98. That was the high that we saw back here in November last year before that dollar retracement took the pair lower. But again, likely to see a lot of resistance on the way up as markets test that appetite to push higher and really that skepticism as to whether Japanese officials will intervene. So it looks like for now, continue to have a bullish bias, but struggling to really consolidate higher. We've now reached that level where it is starting to be questioned. The RSI has pulled back a little bit from that overbought territory, so we could potentially see that pull back even further. We do seem to have an ascending trend line support, which would currently be resting about 148.85. If that were the case, then we could see a little bit of a pullback, allowing new buyers to come in before moving higher once again. But as I said, the fundamentals are pointing towards dollar-yen appreciation, but limited by those concerns about FX intervention. Also, the fact that the Bank of Japan may end negative policies in April could see traders starting to anticipate that move and pricing in that and potentially strengthening the yen against the dollar at least a little bit, allowing the pair potentially to pull back to a more long-term sustainable level below 146, 145 in the longer term. That is it for today's analysis on dollar yen. Thank you so much for watching and don't forget to subscribe to our channel.